from sunny and blistering hot Chicago, where it's almost 90 degrees today, and where the Chicago Bears have a bye week, and I'm bummed out because there's no football for me this week. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money bi-weekly podcast. Today's date is Sunday, October 5th, 2025. In today's podcast, our focus is on the S&P 500's amazing 40% rally off of its April lows, which were set almost to the day 6 months ago. This despite the fact that the U.S. government has now been shut down for a week amid threats of mass firings from the White House. Some analysts, including one of my favorites, Stephen Ratner, who was on Wall Street Week this weekend, believe that the rally can persist because of low interest rates and primarily because of AI. Because AI has the potential to spur productivity and more growth, even with less jobs, and do this without inflation. At Asbury Research, our focus is not trying to handicap the market from an economic standpoint, but rather we focus on what the market thinks via our own data-driven models, which tell us if the market is greedy, if it's comfortable, if it's fearful, what the participation is, where the money is going around the various ETFs. And so basically, we shifted back to risk on according to our CPM model, the correction protection model, which we're going to look at in just a minute, on April the 24th. And we remain risk on today. Moreover, 3 of our 4 model portfolios, which we've constructed from bits and pieces of our various models, 3 or 4 of them are outperforming the S&P 500 year to date by a significant amount, and all with lower drawdowns, lower standard deviations, and lower beta than the S&P 500, which means less downside risk. This 40% rise in the S&P 500 is going to ultimately lead to a correction. It's inevitable. It's going to happen. And because we've come so far so fast, 40% in 6 months, the potential for this next corrective move down, or if it's a new downtrend, we don't know yet. It hasn't happened, but it has a potential of being particularly nasty and particularly damaging to your portfolio, again, because we've come so far so fast. When it does, our models are going to let us know that the conditions have changed. Our Asbury 6 and our CPM will do that, and we'll get out of the way like we always do, and then we'll look to reallocate our capital at much better prices, much lower prices. When the move down is over, our indicators tell us the market is gaining confidence again. Participants are starting to gain confidence again. And again, we do this just by following the money. Before we get started looking at charts, data, and updated models, here's a little bit of information about us. Asbury Research is a registered investment advisor. We're an RIA, and we've been providing both investment research and asset management to individuals and professional money managers since 2005, which makes this our 21st year in business. We have 2 levels of research service available. Our Asbury Premium, which is kind of our flagship. That's what we started the business on in 2005, selling research to institutions that were managing other people's money, portfolio managers. We've since expanded that out. We also work with individuals, but Asbury Premium is for more serious investors, more hands-on investors who understand markets reasonably well. It includes the latest updates on all of our models as they occur, and some personal instruction on how to use them. We do this via Zoom, and to help you use the service quicker and input these ideas into your portfolio. We also have an entry-level Substack newsletter for $25 a month. That's what it looks like right there. This is for those that aren't market savvy or are learning, or maybe don't want to invest a lot of money in our premium service until they learn a little bit more about us and get a better feel for what we're doing. Doesn't include any of our trading models, but it offers some selected portions for premium research product. There's also a free version of the Substack newsletter. AsburyResearch.substack.com is where you find it on the internet. free version here. If you like what we're doing, if you listen to our bi-weekly Follow the Money podcast, if you follow us around the internet as I get interviewed, and Jack's now getting interviewed too, which makes me happy, I strongly suggest that you sign up for the free version. You'll get to learn more about us and get some insights into what the markets are doing, and it'll just, I think, help you to be a smarter investor. We also offer managed accounts. This is a relatively new part of our service. I've been asked to do this for over 10 years. And some people, research isn't for everybody. Some people have a hard time taking the research, the knowledge in the research and the ideas in the research and creating a portfolio out of them. For them, we offer managed accounts. We're now managing money for both individuals and also for other financial advisors, other RIAs that give us a portion of their clients' assets to manage with our various model portfolios, our various models as a third party. We're actually starting to do a lot more business as money managers and would be happy to schedule a quick Zoom with you to show you our 4 model portfolios, how they have performed in our back test, and see if they might be a good fit for you. You can do that right here. Click on Managed Accounts, and this will take you to a little bit of information. And then if you want to have a Zoom with us, we can't just send you the information about the models. We are a fiduciary, and we need, part of what we do is to determine suitability and make sure our clients understand what we're doing. But if that's the direction you want to go to Managed Accounts and follow the prompts. Our ultra conservative model, which is the only one of the 4 that's not outperforming the S&P. It's trailing the S&P by less than 4% year to date, but the maximum drawdown was only 6% compared to 19% earlier this year in the S&P 500. This is for typically older, very risk-averse investors who they're not getting enough from a T-bill. A 1 to 3 month T-bill right now is yielding about 4%, right around 4%. S&P 500, I think year to date, annualized S&P 500, looking back 5 to 7 years, around 12.5%. But again, you're exposed to a drawdown. We had a 19% drawdown earlier this year. So this is the Asbury Ultra Conservative model. It's built to kind of hit that place in the middle. You're going to trail the S&P by a little bit, but you're going to do a lot better than if you buy a T-bill, which doesn't have any risk because it's backed by the U.S. government. Anyways, contact us via the contact tab here with any additional questions on any of this. So let's get to work. Let's start by looking at the correction protection model. So we're going to jump to the Research Center. This is the password protected part of AsburyResearch.com. Here's CPM, correction protection model. While I'm explaining to you what this is, these are the signals that we've had here over the past two years. This goes back to October of 2023. CPM is a completely data-driven dynamic stock bonds allocation model. We built this to be an alternative to the standard 60-40 portfolio. Most investors who use an advisor, they're probably on some variation of a 60-40 portfolio. They probably asked you a dozen questions to try to determine how risk averse you are, how much money you have, are you going to need this money to retire, stuff of that nature. And then they suggest some kind of a stock bond allocation that may have a little gold in it, precious metals. It may have a little bit of international markets. But the reason that we like what we're doing here, I'm going to jump screens on here. So this is our back test, okay? So this is the CPM model going to inception, which is the 4th quarter of 2017. CPM model is green. AOR is an ETF that basically emulates the 60-40 bond portfolio. So CPM has risk protection. 60-40 bond portfolio is assumed to have some protection because you're half stocks and half bonds. The problem with that is sometimes stocks and bonds go up and down together. at the same time. So when that happens, you lose your hedge, so to speak. So blue line, AOR, ETF that represents a 60-40 portfolio. Green is CPM. So let's bounce back real quick. So CPM, it's designed to protect investor assets it's really a dynamic stock bonds allocation, but instead of it being set it and forget it from your advisor, the market tells us when we should be in stocks and when we should be in bonds. It's designed to protect investor assets during a market decline, eliminate the large drawdowns that could really wreck the future plans of older investors that might be drawing on that money. And then you have to eat a big drawdown. It could really change how long your money lasts or what you leave for your heirs, for your kids, for your grandkids after you're gone. So designed to protect investor assets during the market declines, reduce volatility in the account by moving the money either into cash or into some kind of a short-term interest rate, like BIL is the ticker for one that we use. CPM has been risk on since April the 24th. And you can see, there it is, April 24th. Typically, annualized, it moves about 5 times a year from risk on to risk off, or we call it a round turn. Last year it was only 2.5 times. We had a little bit more activity at the beginning of this year, but we avoided about 10% of the 19% decline that the S&P 500 had from top to bottom. So let's go back and look at a couple more charts and try to put a little bit of color here. We're going to look at chart 4. This is CPM versus SPX. It tracks very closely to the S&P 500. The difference is a buy and hold in the S&P 500, it doesn't have any risk control. This does. Let's look at chart 3. This is what we showed you before. This is with risk control with the 60-40 portfolio. This is CPM versus the S&P. So basically what it does is it tracks very closely to the S&P 500 over time, but the maximum drawdown is about 40% less over time. Maximum drawdown in the CPM was 34%. That was during COVID period, just those couple of months, bad months that we had during COVID in the early part of 2020. Maximum drawdown in the S&P has only been about 20%. Just so you know what they mean, standard deviation indicates a smaller price swings and a narrower range of potential returns, implying more consistent returns and lower risk. Lower beta, here's talk about beta. Lower beta suggests a more stable investment, less volatile than the S&P 500. The next one we're going to go to is our SEAF model, our sector rotation model that you might be familiar with. So we're going to go back here to the research center and we're going to go to the SEAF model. So the SEAF model, which is right here, unlike the S&P 500, the SEAF model, there's our current signals in the SEAF model. SEAF model is always fully invested in the market. Whether CPM is risk on or risk off, this is meant to replace that part of most investors' portfolios, most professional investors' portfolios. They can't go to cash. Provides a dynamic alternative to the traditional buy and hold portion of your portfolio. We do this by following the money as it moves around the 11 sector spiders, which together are the S&P 500. We're always invested in the top 3. Right now, effective next week, technology, utilities, and consumer discretionary are the top 3. This is where the money is going the fastest in 3 different time frames: trading, tactical, and strategic. Where the money's coming from are energy, financials, and staples. This helps to tell us where the money is going, and we're always with the money. SEAF has underperformed the S&P 500 by about 2% year to date, due primarily to the frenetic and mostly directionless sector rotation this year, which we attribute to the market is trying to figure out what to do with tariffs. When are the tariffs coming? How much are they going to be? Are they going to be static? How is this going to affect businesses? It's already affecting businesses. Companies are afraid to hire. They're afraid to expand until they figure out what's happening. And now we've got an issue with interest rates. Is the Federal Reserve going to continue to be independent, or is it going to be influenced by Washington? So there's a lot of unknowns. CEF has had a lower max drawdown, lower standard deviation, and lower beta, but we're trailing a couple of percent this year. Since inception in the middle of 2018, CEF has significantly outperformed the S&P 500 on an annualized basis. It doesn't outperform every year looking backwards. Some years there's just not a lot of sector rotation. There isn't that sector that's going to break out of the pack and give us opportunity. But on those years, it's very good at getting on those sectors early and giving you a chance to outperform. Next, we're going to look at our Asbury 6. A lot of people have, they're not sure of what, or they tend to conflate the Asbury 6. So we're back to the research center. They tend to conflate the Asbury 6 and the CPM. CPM is a risk reducing model that, again, tracks the S&P very closely with a lot less risk. What the Asbury 6 is it's meant to be an indicator really rather than a model to track. It's a daily data-driven gauge of the U.S. stock market's real internal health according to 6 diverse metrics, which we selected and put together as kind of a team via quantitative backtesting. Everything we do here is backtested. Every individual indicator has an Achilles heel. I'm always asked, what's your favorite indicator, John? My answer is I don't have one because they all have an Achilles heel. No indicator works all the time. So what we did is we found 6 that are different from each other. We've got relative performance of stocks and high yield bonds. We've got investor asset flows, volatility, trading volume, market breadth. And when 1 or 2 of these breaks down in a certain environment, the other 4 tend to pick it up. 4 or more green here indicates a positive signal. 4 or more red is a negative signal, meaning the internals of the market have become weak. It's been positive as of September the 26th. It's a lot more active. You can see it does a pretty good job of catching the highs and the lows, but sometimes the market will weaken for a day or two and then it'll get better. Think of it as an EKG for the stock market. It's a lot jumpier, but the reason that I look at this is because you can't look at the S&P 500 anymore and get a meaningful determination of what's going on in the market. Some days you walk in and it's down 50. And you're long and you're wondering, okay, what broke? Do I need to get out? The next day, you're down another 70. And now you're getting nervous and now all your research gets thrown out the window and you get out of the market. 3 days later, we're making new highs. It's happened to all of us. It's happened to me. This is meant to keep us focusing on the signal and not the noise. Let's move on and look at some charts. This is our keys to this week. It's one of the weekly reports that we put out for the premium product. And let's begin up here, up at the top. This is where the support is in the S&P 500. It's starting to cluster here between basically 66 and 6,600 and 6,500. We've got the 21-day moving average in red. We've got these 2 lows from September, and then we've got the 50-day moving average, which many people look at as kind of a minor trend proxy. So between 6,600 and 6,500 is where the support is. If that is broken, especially if the Asbury 6 turns red and or the CPM goes to risk off, that's going to indicate to us that there's a top in the market. And it is coming. I don't know when, but it's coming. The next thing I want to focus on is even though the market is really stretched by a lot of standards, it still has leadership. This is the NASDAQ 100 here, the NDX. Down here is the NDX versus the S&P 500, the relative performance down here in blue. with its 63-day moving average, which is the quarterly trend. You can see on April 25th, which is really close, that was really close to our signal to go risk on in CPM, which was the 24th, caught all of this move higher. Started to falter the middle to latter part of August through September the 11th. It was underperforming the S&P. That had me kind of up on my toes and really making sure that we weren't starting to roll over because it lost its leadership. It came back on September the 12th. Big cap tech is now leading. That's what happens typically in a healthy bull market that can go higher. This is the second part of that. This is semiconductors. This is the Philex Semiconductor Index, or the SOX. This is that same chart. This shows that the SOX started outperforming the S&P 500 on May the 9th. They faltered from August the 28th to September 5th. So back during that period, I'm saying, okay, we lost our leadership from semis, and we lost our leadership from large cap tech, and the Asbury 6 started waffling a little bit. So again, it had me on my toes. On September 8th, it started outperforming again, and on September 10th, the SOX made new all-time highs. So had a little wobble, but it never rolled over. So heading into next week, we're getting leadership from all the right places. The last one here in the series that I want to show you is IWM, which is the ETF for the Russell 2000 small cap index. We are breaking out to new all-time highs here. I think small cap is generally less necessary for leadership than the other two that we looked at, the NDX and the SOX. But small cap interest rates are low. Small cap stocks typically like that. We're making new all-time highs. So as crazy as it might be, the market is really in pretty good shape heading into next week. The next thing we're going to look at, we're going to go back to the Research Center, is our ETF ideas. We put out ETF ideas typically about once a week. It's not based on the calendar, it's based on opportunity. But over the past 30 months, it's been about once per week, excuse me, about 4 times per month. Currently, we are, our oldest is we bought Ring, which is the iShares Gold Miners ETF. We bought it on August the 6th. We've got an open trade performance here outright of 34%. It's outperforming the S&P by 27%. These numbers are through Friday. And we continue to move our stop higher and higher and higher. That's why these are yellow. These stops have been ratcheted up. XME since 828, up 19%, outperforming SPY by 16%. We added another gold miner on 9/11 because the risk reward, according to our metrics, was extremely good to add. So this is the Van Eck version of the gold miners. We bought it on 9/11. It's up 11% since then, outright outperforming the S&P by 9. We bought copper miners. You notice the theme here. A lot of the precious metals are doing really good, and it started in August. We caught the first one pretty early on August the 6th for Ring. So COPX, since we bought it on September 15th, it's up 14%, outperforming the S&P by 13. And we just bought XOP last week, which is oil and gas. Oil and gas is making some noises like it wants to go higher. It isn't clear to me yet that that's what's going to happen, but we decided to put on a preliminary idea there, and that's down 3% so far, underperforming the S&P by 4. How we do this is we do a quantitative scan of 63 or 6,500 ETFs every morning at 5 in the morning, and it gives us a list of ETFs that are trending higher, outperforming the S&P 500. I don't believe in buying anything if it's not outperforming a buy and hold S&P. If all you're going to do is buy and hold S&P, you don't need us. And the third thing is we want to see asset expansion. It gives us a list. Then the fourth leg of that is I look at them I spent 17 years on the trading floor when I was a kid. I understand risk reward pretty well. And I look at these in terms of what do I have to risk in order to put a position on in this particular ETF. So this is what our numbers look like. This is going back 30 months, 2.5 years, 111 trades. This is kind of a learning moment, I think, or I hope it is for you. The key to a winning strategy that you can do over and over and over again is you want to have more winners than losers. So 54% winning trades. You might say, well, John, it's only 54%. It's probably not a real good model. Well, the other part of that is how big are your winners compared to how big are your losers. Our average winning trade is almost 5.5%. Our average losing trade is less than half that at 2.4%. So ratio of winning trade, 2.3 to 1. So our winners are 2.3% bigger than our losers. Average winning trade in days, 18 days or about a month. These are trades, they're not investments. Average losing trade in days is 8 days or about a week and a half. So that's how we determine individual trading ideas. The last thing we're going to look at really quickly is our sort report. It's part of our Substack. We're going to go back to Substack here real quick. And we're going to click on the sort report. This is quantitative. All we're doing here is we're looking at these various asset classes: gold, emerging markets, U.S. technology, crypto, small cap, global equities, ex-U.S., the rest of the world's equity markets, commodities, interest rates, crude oil, and dollar. It sorts them according to, again, trend, relative performance, and money flows. These top 5 here: gold, emerging markets, U.S. technology, crypto, small cap, there's actually 6 of them, and global equities are all clicking on all 3 of those cylinders, so to speak. That means these are places that you may want to go and further explore and maybe look for an individual stock there. Look for an individual ETF there, subgroup, whatever it might be. But this is a part of our Substack, and this is updated, I believe, twice a week, along with some other research that you get there. So we looked at a lot of stuff today. Hope it was useful to you. That wraps it up for our latest Asbury Research Following the Money podcast. Our next Following the Money is tentatively scheduled for Sunday, October the 19th, 2 weeks from today. I hope you see you there. In the meantime, if you have any questions or want more information on any of the stuff you saw here today, any of the research, our managed accounts, you can contact us right here at asburyresearch.com and go to the contact tab. Have a great Sunday. Have a great week. And don't forget to like and subscribe. Have a great Sunday. We'll see you in 2 weeks.